Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing PayPal stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. PayPal transacts online payments in most countries around the world. It serves as an electronic alternative to traditional paper methods such as checks and money orders. The company operates as a payment processor for online vendors, auction sites such as eBay, and many other commercial users by charging a fee. PayPal owns Venmo, Braintree, Honey, and many other companies. They recently tried to acquire Pinterest, but that deal fell through. One of its co-founders is Peter Thiel. It was originally called Confinity, and the company developed security software for handheld devices. It had no success with that business model, so it switched its focus to a digital wallet, which was the first version of PayPal. In 2000, it merged with X.com, an online financial services company founded in 1999 by Elon Musk. After Confinity and X.com merged, Elon Musk was replaced by Peter Thiel as CEO. Then in 2001, they renamed the company PayPal. It went public in 2002. Also in 2002, it became a wholly owned subsidiary of eBay at a purchase price of $1.5 billion. In 2015, eBay spun off PayPal into an independent company once again. In the third quarter of this year, there were 416 million active PayPal accounts, 4.9 billion transactions, and $310 billion worth of transactions. This company controls 17% of the entire market, and that is expected to grow to 24% by 2025. The company is headquartered in San Jose, California, was founded in 1998. It trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Xetra, Vienna, EuroTLX, Swiss, Sao Paulo, Lima, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 241 billion market cap. They're trading at $205 a share, and they have 1.2 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They generate lots of free cash flow. It peaked in the trailing 12 months at over $5 billion. Net income is revenue minus expenses, and that's pretty strong each year, also peaking in the trailing 12 months at $4.9 billion. Revenue is the sales for the company, and that grows at a nice pace each year from $15 billion up to $23 billion. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their revenue from 2018, 19, and 20. So each year, pretty much half their revenue comes from the US, and the country with the second highest revenue is the UK. In 2020, 93% of their revenue is the fee they charge per transaction. 7% is value-added services. So value-added services is revenue from partnerships, referral fees, subscription fees, gateway fees. Gateways are links to bank clearing networks in order to process transactions. They also generate revenue from the interest and fees on the loans they provide. This is the income statement from their 10K. This gives a little more information. Their largest expense is transaction expenses. These are the fees they pay to the financial institutions. The fee PayPal charges its customers covers these costs, but PayPal still has to spend money on things. They have to post funds in case there's losses. They offer buyer and seller protection programs. There's also fraud sometimes or chargebacks. These are not the actual losses they paid. These are just the funds that are put into a separate account to fund those losses. I'll show you in a statement of cash flows later their actual credit losses. Then they have to pay employees for customer support, that's $1.8 billion, sales and marketing, $1.9 billion. They spend $2.6 billion in technology and development, $2 billion in general and administrative expenses. They have positive operating income and positive net income each year, and it's growing, so it's a pretty strong income statement. This is the company's statement of cash flows. The top line is the operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They spend $700 million to $900 million in CapEx each year. For this company, CapEx is computer equipment, software, the website development costs, and they may buy real estate so they have an office for their employees. And CapEx is put onto the balance sheet and then depreciated or amortized over its useful life. Operating cash flow minus CapEx gives you your free cash flow, and they have a lot of free cash flow. And that's the money that's due to you, the investor. So the company can pay a dividend, but they don't. They buy back a lot of stock though. They bought back $3.5 billion in 2018, $1.4 billion, $1.6 billion, then $2.1 billion. When a company buys back stock, that decreases the shares outstanding, making your shares more valuable. They do add debt every year. They added $900 million in 2018, $3 billion in 2019, and almost $4 billion in 2020. They may be adding debt to acquire other companies. This is their 2020 cash flow from operations section. And the way you calculate cash flow from operations, you start with net income, then you have to add or subtract the non-cash items on the income statement. So that $1.7 billion expense for transaction and credit losses, we have to add that back on the statement of cash flows because they didn't actually spend that money. That's just put up as a reserve. You can see down here, they actually had $1.1 billion of credit losses. Then they have to add back $1.2 billion of depreciation, $1.4 billion of stock-based compensation. So even though they reported a $4.2 billion profit, they actually generated $5.9 billion of cash flow. This top part is the cash flow from investing section. And it starts with CapEx, that was $866 million. And they always have lots of cash sitting in their bank accounts. When somebody gives them money, it usually takes them a day or two, or sometimes 3 days if it's international, to get to the receiver of the money. So at any given time, they're holding tons of money in their bank accounts. So they invest that overnight in short-term investments and earn a little interest on that. So you can see they invested $41.5 billion and sold $31 billion of investments. This is a big way financial institutions make money. The bottom part here is the cash flow from financing section. They bought back $1.6 billion of stock. They added $7 billion of debt, and they paid down $3 billion of debt. This $10.6 billion of funds payable to customers, and you can see that's the difference between the $41 billion they invested and the $31 billion that they sold. Here's the equity section of their balance sheet. They bought back over $10 billion of stock. They raised $17 billion from selling their business, and they profited $16 billion from running their business. Let's look at the capital structure. $22 billion of equity, $8 billion of debt. They're 74% equity, 26% debt. Their net debt is negative $5.3 billion, so they could pay off all the debt with the cash on their balance sheet and still have $5.3 billion of cash left over. And their WACC, according to Simply Wall Street, is 6.57%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $268 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $236 billion. We divide that by 1.2 billion shares. And we get a calculated stock price of $200. They're trading at $205, so they're trading at a 2% premium. It's a sell according to the model, but it's really close. The average analyst projects their revenue to grow 18.2%. I grew their revenue 18.2% for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers. And that comes out to 24%, so I multiplied their future revenue estimates by 24%. That's how I got their future free cash flows. If my model is fairly accurate, you would expect these big stable companies to be trading pretty close to intrinsic value. If the company is expected to have massive growth in the future like Tesla, maybe the valuation will be way lower than they're trading at. Or possibly the opposite, with another company, the valuation will be way higher than they're trading at. Simply Wall Street's valuation is $254, so they're saying the stock is 19% undervalued. 13 analysts priced this stock. The average price target was $326, the low was $200, the high was $375. This is where the stock has been trading since 2017. You could have made an amazing return if you bought this stock only 4 years ago. It was well over $300 a share. Since it's trading at $200 now, it could be a great opportunity because it was $300 at one point, and it's not like the company is struggling, they're actually improving. One reason why the shares dropped is because the volume of payments from eBay has dropped a lot. probably due to Amazon. But eBay is a pretty small part of PayPal's total revenue. This just happens a lot when a stock price gets really high really fast. People sell off and take in their profits. But I wouldn't be surprised if this stock was trading at $400 sometime next year. Every year, the company grows their total accounts. In 2015, there were 181 million PayPal accounts, and that more than doubled to 377 million in 2020. Now it's over 400 million. Customers are using their platform more often. In 2015, the average customer made 28 transactions, and that grew to 43 in 2020. I've been using eBay for a long time, so I'm so used to it. I don't really use Amazon, and for my business, every day I use eBay. So I must have used it 500 times last year. Their beta is pretty close to 1, so the stock moves with the market. It's gone up 22% in the past 52 weeks, while the S&P is up 32%. The 52-week low was 178, the high was 310. The stock is trading well below its 50-day and 200-day moving average. This is a really popular stock. Over 14 million shares are traded each day the past 10 days. Pretty much all the shares outstanding are on float. 82% are held by institutions, and only 1% of the shares are shorted. Every year the company grows, they acquire other businesses, they also grow organically. Their employee count also grows every year up to close to 27,000. If you invested $10,000 into this company in 2015, even with the big drop off recently, you'd still be at $56,000 today. That's a 31% annual return. There's only one insider trade the past year. It was a sell for 5,200 shares. Vanguard is the biggest shareholder at 8%, then BlackRock, State Street, Fidelity, and Capital Research. Let's look at their financial ratios. Their PE is on the higher side at 49, but this indicates the company is going to be growing a lot in the future, which I definitely see that happening. Their price to sales is also high at 10.6 and price to book of 11. They have 22 billion of equity, 11.7 billion of tangible equity, since they have over 10 billion of intangible assets on their balance sheet. They have a great return on invested capital of 19%. They could cover their interest payments 16 times. A high ROE of 22%. They have a good current ratio and quick ratio of 1.3. They have 13 billion of cash or short-term investments on their balance sheet. $3.7 billion of loans that are owed to the company. And this is net of expected losses. So they probably have more than $4 billion of loans. But a company is supposed to assume they're not going to receive 100% of the money that's owed to them. They have 35 billion of funds receivables. These are the funds that are transacted to them, but they're going to get that money. It's just in a holding period between them and the financial institution. They're really well capitalized. They have over $5 billion of free cash flow in the trailing 12 months, 12 billion of working capital. Working capital is current assets minus current liabilities. So they have over $17 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 6 companies in the same industry as PayPal. And if PayPal has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they are a little better in price to earnings because the average is pretty high in this industry. They're a little worse in price to sales. They're much better in price to book. They're lower in current ratio, but 1.3 is fine. They do have a high ROE, but it is lower than average. They're a lot lower in debt than the average company. They have the lowest on this list. And they're a massive company, 241 billion market cap. Visa is twice their size, but Visa has been around since 1958. They've been around since 1998, so it's pretty impressive how big PayPal is in such a short amount of time. So to summarize, I have them trading at a 2% premium, but they are the kings of this industry. I pretty much only use PayPal and Venmo, and since PayPal owns Venmo, I'm giving all my business to PayPal. Some people may say there's no need for PayPal because of cryptocurrency, but a lot of people aren't that comfortable with cryptocurrency. Plus, it's a really volatile currency. I love PayPal for the convenience, and I can't imagine going to another company because I don't even pay any fees with PayPal. The person I'm buying the product from pays the fees. And it's so secure because you don't have to give out your bank account information or your credit card number. It's all stored within PayPal. I like this company a lot. Even though their market cap is really high, it has come down a lot. So I think there is a good amount of upside. But it's hard to know when the bottom is. It could come down even more to 180, 170. It's really hard to know. But if you're bullish on this stock or any stock, just buy and hold. Don't try to time it. It almost never works. I rank their free cash flows 8 out of 10, their revenue 8 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.